What if I told you that in certain California zip codes, owning a home in 2026 could feel less like the American dream and more like catching a falling knife? We are not talking about a gentle cooling off period. We are talking about a mathematical collision between inflated values, vanishing demand, and economic reality that could wipe out years of equity before most homeowners even realize what happened. Welcome back to Tax Hack Pro. We don't just follow the headlines, we follow the data that the headlines are afraid to touch. If you want to protect your wealth from the next market correction, you need to subscribe to Tax Hack Pro right now. Hitting that subscribe button is the smartest investment you will make today. The real estate narrative right now is confusing. The news tells you inventory is tight and prices are resilient. Your neighbor tells you their house is worth a fortune, but the underlying numbers in specific California markets tell a terrifyingly different story. We are seeing the classic signals of a bubble in very specific locations. Prices that have detached from local incomes, a sudden spike in investor exits, and a quiet but steady drain of population. In this deep dive, we are going to expose the 10 California cities most vulnerable to a price crash in 2026. We are using raw data, migration trends, and economic indicators to show you where the ground is shaky. And you need to stay until number 1, because it is a city that saw massive appreciation during the pandemic, and now the hangover is going to be brutal. Let's start with a city that was once the hottest alternative to San Francisco. Number 10, Oakland. For years, Oakland was the smart play. It was the Brooklyn to San Francisco's Manhattan. Tech workers flocked there for the culture, the weather, and the relative affordability. But that narrative is fracturing. During the pandemic, home prices in Oakland surged to levels that local wages simply cannot support. Now the remote work wave is receding, and the demand that propped up those prices is evaporating. The data is alarming. Sales volume has plummeted. Homes are sitting on the market for weeks, sometimes months. Price cuts, once rare, are becoming the standard way to close a deal. But the biggest red flag is the exodus. Oakland is losing residents. People are leaving for cheaper, safer, and more stable markets. When you have a net outflow of people but a static supply of housing, the laws of economics dictate that prices must fall. Add in the rising cost of insurance in California, higher property taxes, and genuine concerns about public safety, and you have a recipe for a correction. Investors who bought rental properties expecting endless appreciation are now looking at their spreadsheets and realizing the math doesn't work. They are starting to sell. When investors rush for the exit at the same time regular buyers pull back, inventory spikes. And when inventory spikes, prices crash. If you're thinking of buying in Oakland, wait. Patience is your best asset right now. Watch the rental market soften. Watch the price cuts deepen. The bottom hasn't fallen out yet, but the floor is definitely creaking. Number 9, Bakersfield. Bakersfield was a pandemic darling. It was affordable, spacious, and perfect for remote workers. Prices skyrocketed as people fled the coast for the Central Valley, but that rapid growth was built on a shaky foundation. Bakersfield's local economy hasn't changed. It is still heavily reliant on energy, agriculture, and blue-collar sectors. These are vital industries, but they are cyclical. The disconnect here is massive. Home prices rose much faster than local incomes. The market was driven by external money, investors and coastal transplants. Now, that external money is drying up. Investors who bought cheap rentals are finding that they can't raise rents fast enough to cover higher interest rates and insurance costs. They are the first to sell when the market turns. Bakersfield is also highly sensitive to migration. People moved there for affordability, not because they fell in love with the location. If the job market weakens, or if return-to-office mandates force people back to the city, the demand for Bakersfield real estate could vanish overnight. Unlike coastal cities with diverse economies and international appeal, Bakersfield doesn't have a safety net. If the broader market sneezes in 2026, Bakersfield could catch a cold that turns into pneumonia. Number 8, Riverside. Riverside is the classic spillover market. When Los Angeles and Orange County get too expensive, people drive east. During the boom, Riverside saw incredible appreciation, but spillover markets are always the most volatile. They go up fast and they come down hard. The commute is the killer. As employers demand workers back in the office, that 2-hour drive to LA is no longer a minor inconvenience. It is a deal breaker. Demand is softening as the reality of the commute sets back in. Riverside also faces a massive affordability crunch. Buyers stretch themselves to the limit to get into homes at peak prices. Now, with interest rates staying higher for longer, new buyers can't qualify, and existing owners who need to sell are finding no takers. The local economy is heavily tied to logistics and warehousing. If consumer spending slows down and warehouses start laying people off, the local buyer pool shrinks even further. Plus, developers have been building like crazy in the Inland Empire. New supply is hitting the market just as demand is cooling. That is a dangerous combination. If you appreciate honest analysis that helps you keep your money safe, make sure you are subscribed to Tax Hack Pro. We are building a community of informed investors who know when to hold and when to fold. Number 7, San Diego. San Diego is beautiful. It is desirable. It is also dangerously expensive. Prices here have climbed into the stratosphere, completely detaching from what the average local can afford. We are seeing a market that is priced for perfection, but the economic environment is anything but perfect. The affordability gap in San Diego is one of the widest in the nation. You need a massive income to buy a median-priced home. As interest rates bite, the pool of qualified buyers is shrinking to a puddle. Sellers are starting to realize that there just aren't enough people who can afford their asking prices. San Diego also has exposure to specific sectors like biotech and tourism. If the economy slows, tourism dollars drop and biotech funding dries up. That hits the high-end market first and then trickles down. Another factor is the luxury freeze. High-end markets often lead corrections. When wealthy buyers get nervous about the stock market or the economy, they stop buying vacation homes and investment properties. We are already seeing transaction volumes drop in the luxury segment. That freeze is going to spread. San Diego doesn't need a crash to see a correction. It just needs a return to sanity. And sanity means lower prices. Number 6, Santa Monica. Santa Monica is the crown jewel of the West Side. But even diamonds can be overpriced. The market here is driven by the ultra-wealthy and the tech elite. And right now, both of those groups are feeling cautious. Buyer saturation is real. Prices are so high that there is almost no one left to buy. The air is thin up there. Even a small increase in listings can tip the scale from a seller's market to a buyer's market. Santa Monica is also uniquely exposed to the tech sector and the stock market. Many buyers use stock options for down payments. If tech stocks wobble, buying power evaporates. We are seeing buyers hesitate, waiting to see which way the wind blows. Add in the mansion tax and strict rent control laws, and Santa Monica becomes less attractive to investors and developers. Longtime owners are looking at their property tax bills and insurance premiums and deciding it might be time to cash out. If enough of them decide to sell at the same time, prices will have to come down to find a clearing level. Number 5, Victorville. Victorville is the poster child for boom and bust real estate. In the last cycle, it was one of the hardest hit cities in the nation. And unfortunately, history looks like it is about to repeat itself. During the pandemic, Victorville exploded. People desperate for homeownership drove out to the high desert where they could actually afford a yard. Prices surged, but the economic fundamentals of Victorville haven't changed. It is a commuter town with a limited local job market. The risk here is speculative buying. Investors flocked to Victorville because the numbers looked good on paper. But now, with rents stabilizing and expenses rising, those numbers are falling apart. Speculators are notoriously fickle. They buy in herds and they sell in herds. Victorville is also vulnerable to new construction. There is plenty of land in the desert. Builders can add supply quickly, undercutting resale values. If you own in Victorville, you are competing with brand new homes that might be offering incentives you can't match. Historically, the high desert corrects deeper and faster than the coast. It is the first to fall and the last to recover. If we see a recession or even a slowdown in 2026, Victorville is going to be on the front lines. Number 4, Yuba City. You might not think about Yuba City often, but it represents a specific type of risk. The small market trap. Prices here went up because people were fleeing Sacramento and the Bay Area. But Yuba City is a small economy based on agriculture and government jobs. When a small market gets inflated by outside money, it becomes incredibly fragile. There isn't a deep bench of local buyers to support these new price levels. If the out-of-towners stop coming, who buys the houses? Yuba City lacks the diversity of a major metro. If one major employer cuts back, or if the agricultural sector has a bad year, the housing market feels it immediately. There are no international buyers swooping in to save the day. Small markets also experience more volatility. Prices can swing wildly based on just a few dozen sales. If inventory ticks up even a little bit, it can overwhelm the small number of active buyers, forcing prices down sharply. Yuba City homeowners might wake up to find their equity has evaporated because the few comparable sales in their neighborhood were distressed sales. Number 3, Sacramento. The state capital was one of the biggest beneficiaries of the remote work era. Bay Area workers moved in droves, bringing Bay Area salaries to a much cheaper market. prices boomed, but now the tide is turning. The return-to-office mandates are hurting Sacramento. If you have to be in San Francisco 3 days a week, Sacramento is a tough commute. The flow of high-income buyers is slowing down. Sacramento also has a heavy concentration of investors. They bought rentals expecting rent growth to continue forever. It hasn't. Rents are softening, and holding costs are rising. Investors are starting to do the math and realizing they might be better off selling. Affordability is also a major issue. Locals have been priced out of their own city. The gap between local wages and home prices is unsustainable. Without the Bay Area money pumping up the market, prices have to revert to what locals can afford, and that number is significantly lower than where we are today. Number 2, Palo Alto. It seems impossible that Palo Alto could crash. It is the heart of Silicon Valley. It is where the billionaires live, but that is exactly why it is vulnerable. It is a one-industry town, and that industry is tech. Palo Alto prices are driven by stock compensation. When tech stocks are flying high, buyers have millions to spend. But when the tech sector contracts, or when stock prices stagnate, that wealth effect disappears. We are seeing layoffs and cost-cutting across the tech sector. That anxiety translates directly to the housing market. Transaction volume in Palo Alto is low. It doesn't take many sales to set the market price. If a few sellers need to get out and accept lower offers, it drags down the value of every home in the neighborhood. Also, don't underestimate the impact of remote work on the commercial side. If startups don't need office space on Sand Hill Road, do their founders need to live in Palo Alto? The premium for location is shrinking. Palo Alto will always be desirable, but at these prices, it is priced for a perfection that no longer exists. A correction here could be swift and shocking. Number 1, Barstow. This is the most dangerous market on our list. Barstow saw a massive run-up in prices, but it wasn't driven by jobs or economic growth. It was driven by pure speculation and desperate affordability seekers. Barstow's economy is fragile. It relies on transportation and logistics. It has very little high-paying employment. The people who bought here often did so because it was the only place they could qualify. That means they are likely financially stretched. If the economy softens, Barstow homeowners have no cushion. Foreclosures and distress sales could spike here faster than anywhere else. And because it is a small, isolated market, there is no one to catch the falling knife. Investors who bought cheap properties in Barstow are going to try to exit all at once. Inventory will flood the market, and prices will collapse. We have seen this movie before in the high desert. It doesn't end well. Real estate is hyper-local. What happens in Barstow doesn't necessarily happen in Beverly Hills, but the trend lines are clear. The era of easy money and endless appreciation is over. We are entering a new phase of the cycle, one where fundamentals matter again. If you own a home in one of these cities, you need to be realistic about its value. If you are looking to buy, you need to be patient and ruthless with your offers. The market is shifting in your favor. If you found this breakdown valuable, please hit that like button. It helps us reach more people who need to hear this message. And don't forget to subscribe to Tax Hack Pro for the most honest, data-driven financial analysis on YouTube. Tell me in the comments, are you seeing price cuts in your neighborhood? Is the inventory piling up? Let's share what we're seeing on the ground. Stay safe, stay liquid, and I'll see you in the next video.